Introduction to investing in stocks. The stock market has been a hot topic recently, with record high inflation and insufficient wages. It can be a necessary instrument in growing your money. Fortunately, there is a low barrier to getting into the stock market, with being able to get started with as little as $5 at any major brokerage firm such as Fidelity or Charles Schwab. But to be a good investor, the first step is to learn what stocks even are. First, there are two types of stock: common stock and preferred stock. Preferred stock is a lesser known and not so important classification of stock where businesses issue it to the open market to raise cash from selling them at a particular par value. And this is for investors to trade or hold it, and it usually has an above average dividend yield, the money they pay you for holding the stock throughout each year. That can range from 1 to 8% or more in some rare cases. This type of stock does not give you ownership over the company, and instead is mostly just a claim to dividends companies pay out for you holding the stock. Because the dividend yield is about the only return the stock provides, the price tends to remain relatively stagnant throughout the trading days since the return on the stock is pretty clearly laid out and predictable. Common stock, however, is the stock 99% of the time referred to whenever someone talks about the stock market or buying a company's stock. Common stock represents ownership in a company, and while every business has stock to signify owners, typically only companies that have undergone a process known as an initial public offering, where their stock begins to trade on markets such as the New York Stock Exchange and the NASDAQ, have their stock available for everyday investors like you and I to buy. While you may see stocks at varying prices, such as Chipotle at $1,670 or Apple at $160 at the time of this video, that alone has no implication as to which company is bigger. A necessary yet simple formula that is critical to know is that the price of a stock multiplied by the number of stock in circulation on the market, including those held by individuals, is equal to the market capitalization. The market capitalization is what is measured when evaluating the size of a company, and that is why Apple, with approximately 16 billion shares outstanding, is worth more than Chipotle, with approximately only 28 million shares outstanding. This leaves Apple with a market cap around 2.7 trillion, the largest company on the market, whereas Chipotle has a 46 billion market cap, sizable, but only 2% of the size of Apple. As mentioned before, where you own common stock, you own a fraction of the company, and therefore the business works to increase your money by working for higher profits, which ultimately leads to you making money through three main ways. One is through dividends. While not all common stock or companies pay dividends, those that do give a percent of their profits each year to shareholders, so you get paid for just holding the stock. Another way companies increase value is by share buybacks, where companies buy back their stock on the open market, resulting in the price appreciating of the stock by the percent they bought back. For example, if they buy back 1% of the circulating supply of stock, their stock will go up about 1% in value. Lastly, increasing what's called the book value of the company, the assets of the company minus all of its liabilities, will over time increase the value of the stock since the company could always be bought out by another company on the open market. If the value of a company is ever less than the book value or at a relatively close valuation, then it would be an attractive buyout opportunity from a larger corporation. There are other reasons a company's stock may increase in value, such as the future earnings may be expected to grow at a large rate, signifying the company's valuation to likely go up in the future as a result. Or if a company is bought out by a larger corporation, they tend to be bought out with a premium as a gift to present investors and holders of the company's stock, so they can see a near-instant modest return in exchange for no longer being able to be an owner of that said company. When investing in the stock market, there are many other factors to consider, such as valuations compared to earnings, management, and macro trends across consumers and the economy. But learning the basics of what stock is and characteristics of it is a good starting point. Leave a question in the comments on anything covered or not in this video, and we will be happy to get back to you. Hopefully the knowledge from this video is a start, and we thank you for watching.